The ongoing US-Iran conflict is exerting a deeply interconnected and multidimensional impact on the Indian stock market, with crude oil prices acting as the primary transmission channel, but with ripple effects extending into inflation, currency stability, capital flows, sectoral performance, government policy, and India's broader geopolitical positioning under its current foreign policy framework. At the core of this impact lies India's structural vulnerability as one of the world's largest importers of crude oil, relying on imports for roughly 80–85% of its energy needs, with a significant portion of these supplies passing through the strategically critical Strait of Hormuz. This narrow maritime corridor is a key choke point for global oil flows and becomes highly sensitive during any escalation involving Iran, meaning that even the perception of disruption, let alone actual supply constraints, can send global oil prices sharply higher. For India, which lacks sufficient domestic energy buffers, such price spikes translate almost immediately into higher import costs, widening the current account deficit and placing downward pressure on the Indian rupee, as more dollars are required to finance energy purchases. The depreciation of the rupee further compounds the problem by making all imports more expensive, thereby feeding into inflation and amplifying economic stress across the system. Inflation emerges as one of the most critical channels through which the conflict affects Indian equity markets, as rising crude prices directly increase the cost of fuel products such as petrol, diesel, and LPG, which in turn cascade across the economy by raising transportation, logistics, and production costs. This cost escalation impacts a wide range of sectors, from agriculture, where higher fuel costs increase the price of moving goods, to manufacturing, where energy and raw material costs form a substantial portion of expenses. Food inflation can rise as supply chains become more expensive to operate, while industrial companies face shrinking margins as they struggle to pass on higher costs to consumers without dampening demand. This creates a classic cost-push inflation scenario that reduces corporate profitability and compresses earnings expectations, leading to downward pressure on stock valuations. As a result, benchmark indices such as the Nifty 50 and Sensex often experience heightened volatility during such periods, reflecting both the deterioration in macroeconomic fundamentals and the uncertainty surrounding future earnings growth. Investor behavior plays a crucial role in amplifying these market movements, particularly the actions of foreign institutional investors, FIIs, who hold significant stakes in Indian equities. During periods of geopolitical tension, global investors typically shift toward a risk-off stance, reallocating capital from emerging markets like India to safer assets such as U.S. Treasury bonds, gold, or the U.S. dollar. This capital outflow not only depresses stock prices, but also exacerbates currency depreciation, creating a feedback loop that intensifies market stress. Domestic institutional investors, DIIs, may provide some counterbalance, but they are often unable to fully offset large-scale foreign outflows, especially when global sentiment turns decisively negative. Consequently, the Indian stock market becomes highly sensitive to external shocks, even if domestic economic fundamentals remain relatively strong. The weakening of the rupee introduces a nuanced dynamic, as it creates both challenges and opportunities depending on the sector. Import-dependent industries such as oil marketing companies, aviation, and certain segments of manufacturing face significant margin pressures due to higher input costs and unfavorable currency movements. Aviation companies, in particular, are heavily exposed to fuel prices, which constitute a major portion of their operating expenses, and rising costs can quickly erode profitability while also reducing passenger demand as ticket prices increase. Automobile manufacturers encounter similar challenges, as higher fuel prices discourage vehicle purchases and increase the cost of production. Infrastructure and construction companies also suffer from rising project costs driven by higher prices for fuel, cement, and logistics, which can delay or derail large-scale developments. In contrast, export-oriented sectors such as information technology, pharmaceuticals, and specialty chemicals benefit from a weaker rupee as their revenues, often denominated in foreign currencies, translate into higher earnings when converted into rupees. This divergence leads to a phenomenon known as sectoral rotation, where investors shift their focus towards sectors that are better positioned to withstand or benefit from the prevailing macroeconomic conditions, rather than exiting the market entirely. Energy companies, particularly those involved in upstream exploration and production, are among the primary beneficiaries of rising crude prices, as their revenues and profit margins increase in line with global benchmarks. These companies often attract investor interest during periods of geopolitical uncertainty, serving as a hedge against energy price volatility. However, the situation is more complex for downstream oil marketing companies, which may not fully benefit from higher prices if the government intervenes to control domestic fuel prices in order to protect consumers from inflationary shocks. Such interventions can compress margins and create uncertainty about profitability, highlighting the critical role of government policy in shaping market outcomes. The influence of the current Indian government's foreign policy is particularly significant in this context, as it determines how the country navigates geopolitical tensions and secures its economic interests. Over the past decade, India has pursued a strategy of strategic autonomy, or multi-alignment, maintaining strong relationships with major global powers, such as the United States, while also preserving ties with countries like Iran and Russia. This approach allows India to balance competing interests and avoid overdependence on any single partner, but it also requires careful diplomatic management during conflicts such as the US-Iran tensions. Historically, India benefited from importing Iranian oil under favorable terms, but US sanctions have limited this option, forcing the country to diversify its energy sources toward suppliers such as Saudi Arabia, the UAE, and the United States. While this diversification enhances long-term energy security, it also exposes India more directly to global price fluctuations, reducing the cushioning effect that bilateral arrangements once provided. Foreign policy also plays a crucial role in shaping investor sentiment, as global investors closely monitor India's geopolitical stance and its potential implications for trade, sanctions, and economic stability. A balanced and non-confrontational approach, as demonstrated by India's emphasis on diplomatic resolution and de-escalation in the US-Iran conflict, helps maintain investor confidence by signaling stability and predictability. At the same time, India's active engagement with Gulf countries, participation in international forums, and strategic partnerships with Western nations contribute to securing energy supplies and maintaining critical trade routes, which are essential for economic stability and market confidence. However, even the most carefully calibrated foreign policy cannot fully insulate India from global shocks, particularly when they originate in key areas such as energy markets. Domestic policy responses further influence how these external shocks translate into market outcomes. When oil prices rise sharply, the government faces a difficult trade-off between passing on the increased costs to consumers or absorbing them through subsidies and tax adjustments. Passing on costs can lead to higher inflation and reduced consumption, which negatively affects corporate earnings and stock prices, while absorbing costs can strain the fiscal deficit and raise concerns about macroeconomic stability. Both scenarios have implications for investor sentiment and market performance. The Reserve Bank of India, RBI, plays a critical role in this process, as it must decide whether to tighten monetary policy to control inflation or maintain accommodative conditions to support economic growth. Higher interest rates can help contain inflation, but also increase borrowing costs, reduce liquidity, and dampen investment activity, all of which can weigh on stock market valuations. The interaction between foreign policy and domestic economic strategy becomes particularly evident in India's efforts to enhance energy security and reduce vulnerability to external shocks. The government has been actively strengthening relationships with key energy suppliers in the Middle East, investing in strategic petroleum reserves, and pursuing long-term supply agreements to ensure stability in times of crisis. At the same time, it has been promoting renewable energy initiatives and domestic production to gradually reduce dependence on imported fossil fuels. While these measures contribute to long-term resilience, their impact is incremental, and in the short term, the Indian economy, and by extension, the stock market, remains highly sensitive to global oil price movements and geopolitical developments. Capital flows are another critical dimension of the impact, as geopolitical conflicts tend to trigger a global shift towards safe haven assets, benefiting the US dollar and gold, while putting pressure on emerging market currencies and equities. For India, this often results in FII outflows, increased market volatility, and declines in stock indices. Although domestic investors provide some support, the scale and speed of global capital movements can overwhelm local factors in the short term. The government's foreign policy stance, by maintaining strong diplomatic and economic ties with major global players, helps sustain long-term investor confidence. But in periods of acute uncertainty, global risk sentiment tends to dominate market behavior. Sectorally, the impact of the conflict continues to evolve as conditions change. Energy-intensive industries face sustained pressure from rising costs, while export-oriented and commodity-linked sectors may outperform. Banking and financial services experience a mixed impact, as higher interest rates can improve net interest margins, but also increase the risk of loan defaults and slow credit growth. Real estate may be adversely affected by higher borrowing costs, while consumer discretionary sectors may see reduced demand as inflation erodes purchasing power. Meanwhile, safe haven assets such as gold often see increased demand during periods of uncertainty, benefiting related companies and providing a hedge for investors. From a broader perspective, the Indian stock market's response to the US-Iran conflict reflects a combination of external shocks and internal resilience. While the immediate effects are negative, driven by rising oil prices, inflation, and capital outflows, India's strong domestic demand, growing economy, and strategic policy framework provide a foundation for recovery once the situation stabilizes. The government's ability to navigate complex geopolitical dynamics, maintain energy security, and implement effective economic policies will be crucial in determining the speed and strength of this recovery. In conclusion, the US-Iran conflict impacts the Indian stock market through a complex web of interconnected factors, including oil price shocks, inflationary pressures, currency depreciation, capital flow dynamics, and sectoral shifts, all of which are further shaped by the Indian government's foreign policy and domestic economic decisions. While the short-term outlook is characterized by volatility and uncertainty, the long-term trajectory will depend on the duration of the conflict, the behavior of oil prices, and the effectiveness of policy responses. The current government's strategy of balancing global relationships, securing energy supplies, and maintaining macroeconomic stability plays a critical role in mitigating risks and sustaining investor confidence, ensuring that despite temporary disruptions, the underlying growth story of the Indian economy and its stock market remains intact over the longer term.